In the world of global finance, the movement of money typically follows a predictable path. Wealthy, developed nations often provide financial aid, loans, or investments to countries that are still developing, aiming to support economic growth and stability where it's needed most. This flow of capital is seen as a way to bridge the gap between rich and poor, helping to fund infrastructure, education, and healthcare in less affluent regions. These funds are crucial for building roads, schools, and hospitals, and for giving children and families in developing nations a better shot at a brighter future. The expectation is that support flows from those with more resources to those with less. But recently, a surprising and viral claim began circulating online, one that seemed to turn this logic on its head. According to reports, the Philippines, a country still facing its own development challenges, had pledged a staggering $250 million to the European Union, one of the world's wealthiest and most influential blocs. The idea of a nation with far less wealth stepping in to bail out a group of countries known for their prosperity sparked immediate disbelief, confusion, and heated debate. People on the streets, financial experts, and social media users alike were left wondering, could this really be true? After all, the Philippines still grapples with significant domestic needs, poverty, healthcare shortages, and infrastructure gaps. Why would it send such a massive sum abroad, especially to the EU, which is often seen as a source of aid rather than a recipient? This claim raises important questions about the financial realities and motivations of both the Philippines and the European Union. Is there more to the story than meets the eye? As the story spread rapidly across social media and news outlets, it was often stripped of crucial context, fueling a dramatic narrative, a developing nation coming to the rescue of a developed one. The headlines were sensational, and the posts went viral, but the truth remained unclear. Our goal in this video is to cut through the noise, examine the facts, and uncover what really happened behind the headlines. We'll look at the origins of the claim, the evidence supporting or refuting it, and the broader implications for international relations and public perception. Is this story an example of unprecedented generosity, a clever strategic move, or simply a misunderstanding that was amplified by the power of social media? What does it reveal about how information and misinformation spreads in our interconnected world? Join us as we break down the claim, separate fact from fiction, and search for the real truth behind this headline-grabbing story. The answers may surprise you. To understand the claim, we need to compare the Philippines and the EU. The Philippines, a lower middle-income country, has made economic progress but still faces poverty and infrastructure challenges. The EU, by contrast, is a powerhouse. 27 member states, a massive GDP, and world-leading industries. Historically, the EU has provided development aid to the Philippines, not the other way around. The idea of Manila sending $250 million to Brussels is a dramatic reversal of this norm. The Philippines' budget is tightly allocated for domestic needs. Diverting such a sum to the EU would be politically and fiscally unthinkable. This economic imbalance is the first red flag in the viral story. Let's look at how international aid actually works. International aid, as it's commonly understood, typically flows in one direction, from the world's wealthiest nations to those still developing. This process is often showcased at high-profile summits, where leaders from powerful economies gather to discuss global challenges and pledge support for countries in need. The underlying idea is that richer nations have a responsibility to help lift others out of poverty, promote stability, and encourage sustainable growth. These financial contributions are meticulously tracked and categorized as Official Development Assistance, or ODA, which is a formal term used in international policy circles. The Organization for Economic Cooperation and Development, or OECD, sets the standards for what counts as ODA. According to their definition, ODA is government aid specifically aimed at supporting the economic development and welfare of countries considered less prosperous. So, when we hear about a developing nation like the Philippines supposedly sending hundreds of millions of dollars to a wealthy bloc such as the European Union, it immediately raises eyebrows. This scenario simply doesn't fit the established model of how international aid is supposed to work. Of course, international financial flows are not limited to aid alone. They also include loans, investments, and other forms of economic exchange. However, it's extremely rare for developing countries to act as lenders or donors to developed nations, especially on a large scale. For a country like the Philippines, the risks and opportunity costs of sending significant funds to a wealthier region are substantial. Such a move would be considered illogical from both an economic and political standpoint. That's why recent headlines claiming the Philippines is funding the EU have caused confusion and skepticism. It's an anomaly that doesn't align with the usual patterns of global finance. The details surrounding this claim are shrouded in ambiguity. Was the transaction a grant, a loan, or perhaps something entirely different? The language used in reports is often vague and can be misleading, making it difficult to discern the truth. To truly understand what happened, we need to dig deeper. That means tracing the origins of the story, examining the documents, and following the money trail to see where it actually leads. So let's take a closer look at the financial transaction behind this surprising claim and see if the facts support the headlines. The story's roots go back to the 2012 European debt crisis. The IMF, aiming to prevent global economic fallout, called on all member countries, including the Philippines, to boost its lending capacity. The Philippines pledged to increase its contribution to the IMF's loanable funds, not as a donation, but as a loan commitment. The $250 million figure is a fragment of this older story. The Bangko Sentral ng Pilipinas made the pledge from its international reserves, not from government tax revenues. This was a sign of the Philippines' growing economic strength and a shift from borrower to contributor. Crucially, the money was pledged to the IMF, not directly to the EU. That detail was lost as the story spread. Here's the key point that often gets misunderstood. The funds provided by the Philippines to the IMF were structured as a loan, not as a donation or a form of financial aid to the European Union or any specific country. This distinction is crucial. When people hear about international financial support, they sometimes imagine money being given away with no expectation of return. But in this case, the Philippines was not simply handing over cash, it was making a calculated financial move. The money was deposited with the International Monetary Fund, where it was pooled together with contributions from many other member nations. The IMF acts as a global safety net, using these pooled resources to lend to any member country facing a financial crisis, whether in Europe, Asia, Africa, or elsewhere. The funds are not earmarked for a single region or purpose. They are available to support stability wherever it's needed most. Importantly, the Philippines earned interest on this investment, just like any prudent investor would expect. The principal amount, the original sum loaned, was always intended to be returned in full. This arrangement is similar to placing money in a high-security, interest-bearing account, rather than making a one-way donation. The funds weren't specifically set aside for Europe or any single country. Instead, they could be used to help any IMF member nation in need, reflecting the multilateral nature of the IMF's mission. For the Philippine Central Bank, this was a prudent and strategic use of its foreign currency reserves. By participating in the IMF's lending pool, the country diversified its investments, reduced risk, and contributed to global financial stability, a benefit that ultimately circles back to the Philippines itself. As a nation deeply reliant on international trade, the Philippines has a vested interest in a stable global economy. Supporting the IMF isn't just about helping others, it's about protecting the country's own economic future and ensuring that global markets remain open and resilient. So, the viral narrative that the Philippines was funding the EU is a gross oversimplification. It ignores the reality of how the IMF works and the mutual benefits of international cooperation. The real story is that the Philippines played a small but important role in a massive multilateral IMF effort, one designed to safeguard the world economy, including its own, through collective action and shared responsibility. The global financial system is a web, not a one-way street. Countries like the Philippines invest reserves in secure assets, including IMF deposits, as standard practice. In 2012, the IMF raised over $430 billion from nations worldwide, including Japan, China, Brazil, and the Eurozone itself. The Philippines' pledge was a modest part of this collective action. Singling out the Philippine contribution and linking it solely to the EU ignores the broader context. A Eurozone collapse would have hurt economies everywhere, including the Philippines. Their IMF loan was collective insurance, a small premium to prevent global disaster. The Philippines acted as a responsible stakeholder, not a donor or subordinate. This was a strategic financial decision in a complex, interconnected world. Fact-checking quickly debunks the claim that the Philippines funded the EU. There's no evidence of a direct $250 million payment from the Philippines to the EU in any official record. The EU's budget is funded by its own members, and all bilateral agreements show aid flowing from the EU to the Philippines, not vice versa. The real event was a loan commitment to the IMF, confirmed by the Bangko Sentral ng Pilipinas and the IMF itself. The investment was safe, liquid, and part of the country's international reserves. The viral story resurfaced years later, stripped of its original context and timeline. This decontextualization made the claim more shocking and shareable. A careful look at the facts exposes the misrepresentation. How did a decade-old IMF loan become a story about the Philippines bailing out the EU? It started with a kernel of truth. The Philippines pledged money to the IMF during a European crisis, but the nuance was lost. IMF involvement was dropped, and the distinction between loan and grant erased. The story was simplified and sensationalized, often for political or emotional impact. Social media accelerated the distortion, rewarding viral headlines over nuanced explanations. Once the false narrative took hold, it echoed widely, outpacing corrections and fact checks. The tale persists because it taps into powerful tropes and a lack of public understanding about global finance. It's a cautionary example of how complex realities can be warped into potent misinformation. This saga is a lesson in financial literacy and media skepticism. The truth: the Philippines made a loan commitment to the IMF, not a donation to the EU. The false narrative highlights the need for better public understanding of global finance. The real story signals a shift. Emerging economies, like the Philippines, are now contributors, not just recipients, in global institutions. As economic power spreads, so does the complexity of financial relationships and the risk of misunderstanding. The claim is false, but the conversation it sparked is a reminder. Always question extraordinary headlines. The future will see more nations shaping, not just receiving, the flows of global finance.